Hi, I'm Chris. I'm the host of today's podcast. And we will discuss in this episode a very fascinating topic, namely the stress test results of the EBA. And stress test results are always fascinating if you work in the risk for finance industry, because it tells you how resilient the European banks are facing a downturn economic scenario. And who better to discuss this fascinating topic with than Matthias Coessens. Matthias Coessens is the MD for Europe and co-founder of ElysianNxt. Matthias, welcome to Bangkok.
Thank
welcome
you,
to the
Chris.
studio.
Thank you. Glad to be here.
I can understand that. So tell me more, what were the kind of results of the latest tests that were done in the European bank sector?
So maybe to explain a bit what that stress test was about. So it's a test they do regularly, the ECB. It's across, this time around, it was across 70 banks, over 16 countries, totally about 75% of the banking assets. So basically all the banks that matter were included. And what they check is over a 3-year horizon, they check more a baseline and a real adverse scenario, the outcomes of that on the banking sector. Mm-hmm. And then more specifically on the earnings and the capital required and so on.
If they do this kind of stress test or the adverse test over a 3 years horizon, I mean, how severe are those shocks?
Yeah, some of the shocks were this time around bigger than before. So we have, of course, higher unemployment rates, a serious decline in GDP. I think this time around was bigger than ever, 6% decline in GDP. But overall, I mean, in the end, we thought that the results were quite good. The banking sector is pretty resilient, so it seems. And this is because in the past, they have been stocking up quite a bit on capital since the financial crisis in 2008. So on average, like 15% CET1, which under the adverse scenario did go down to still a comfortable 10.4%. So you could say that, the results were pretty good actually for the banking sector in Europe.
Yeah, 10.4% is quite nice buffer of tier 1 capital to have. So, when you stress it for 3 years under really severe shocks. Was there any specifics around inflation, around interest rates? Because that's quite a hot topic for the moment.
Well, to be fair, to point out as well as part of this exercise is that the earnings for the banks, of course, under these stress scenarios, because some of the stress scenarios, you asked how the severity of the adverse scenario. Okay, I spoke about higher unemployment, I spoke about GDP decline, but also actually higher interest rates, which in itself led to increased earnings. So you see that kind of plays a bit on the upside for the banks under this severe stress.
So kind of write-offs were partially compensated with higher earnings.
Yes. And that's because of the special interest climate we're in at the moment. I mean, we've seen that in the news all over. But there's also a certain situation whereby banks at the moment, they're earning quite a bit due to these higher interest rates compared to the fairly low rates they still give on saving accounts and term deposits.
Yeah, there's quite some public debate around this, because it looks like banks are benefiting on one side because of the higher interest, the higher yields they can charge on their loans portfolios. While at the same time, they're not following the same path on the deposit side.
Yeah, there's two sides of the story. In a way, yes, absolutely. They are not following. I mean, they get quite high returns themselves, but not immediately giving that on their, as I said, on their deposits. So that's a big debate. There's a power play going on actually at the moment in Belgium. Between the government and the banks. So the government tries to force the banks into giving higher rates. There's politically also a serious debate going on. They just issued a government bond, the Belgian authorities, with a net interest rate of 2.7%, which is more than double what you get on a commercial bank savings account at the moment.
Is that because they want to force the commercial banks to increase?
They try to force, which in itself you could say, what's the problem with that? The banks are making a lot of money.
It sounds kind of fair, no?
Yes, but that's when I said there's two sides of the story, because in a way, over the past couple of years, over the past decade even, interest rates have been historically low. And a lot of these banks have been giving like housing loans, which have lengthy 20 to 30 year horizons, at very low rates, fixed, so not variable. So these banks are still with these loans on their balance sheet. So you could argue it's also safe, sound risk management to not immediately follow these fluctuations straight away. That's why there's actually two sides of the story. Yeah.
That's good to understand, because what you hear on television is always the popular story of the politicians. They're not that good in explaining complex economic situations. So it's good to hear the real reasons behind that. You also read something in the Times last weekend that they said, with the success of that 1 year government bond, who's investing in those bonds are people with money on their accounts. Who's paying the interest on those? It's everybody.
Yeah.
So they called it like the Matthias effect, that everybody's paying for the interest, but it's only the more people who are well off who are getting the benefits from it.
It's a big debate. The other special thing is that actually it was so successful for the Belgian government that they actually didn't need that money. They didn't need to collect all that money, but now they have it. So now the next question, how to spend it wisely at this stage.
Maybe put it as a deposit with the banks. Would be the irony of the whole story. And now going back to the stress test results, I read the report. There's quite some sector data available as well.
Yes, I mean, if we zoom in a little bit on the results, you could say the banking sector is very resilient, and that's true. And if you look at, for instance, the credit losses, I think compared to previous stress tests, the credit losses are not so bad. Yeah? But if we then zoom in a bit on a sector level, then you see indeed that the corporate lending, and then especially sectors such as food, hotels, manufacturing, these kind of sectors are having quite severe losses though. But in general, the results look very good. But if you zoom in a little bit deeper, you see that certain sectors do stand out with higher credit losses under this adverse scenario. Yeah. So it's something to still keep an eye on. And that's why it's just, if you just read the top line, it all looks honky-dory. But you might, it's better sometimes to dig a little bit more in the details.
Correct, and also good to have a risk management system that can stress certain sectors.
Exactly. Nowadays proper systems should not do the top-down stress testing anymore. It all has to be bottom-up, and that's only when you can, at a more granular level, start doing stresses on sectors, on certain specific portfolios. That's when you are really doing the job well.
Now, bearing in mind what happened in the beginning of the year, the banks like Silicon Valley Bank collapsed in the US. Is it safe to say that with a capital buffer of tier 1 capital of 10% after 3 years stress test horizon, that European banks are safe, and that we can sleep on both our ears?
European banks, I'd say yes, with Credit Suisse as an exceptional to confirm the
but that's
rule.
more, I think, the reputational kind of damage that was done.
Precisely, but if we compare some of our clients that are very small, very small from an overall bank perspective, 1 billion in assets, and it's considered a small bank, the rules they have to comply with from the EBA and so on to cover, for instance, interest rate risk. That's what Silicon Valley Bank and what actually made them collapse. And then you see what these big banks in the States, that they don't have to comply with these things. The basic shocks of IRB, that's just unbelievable, the big difference in regulation. I think so in a way the European banking sector from that side is a lot safer. Having said that, you can never be safe enough, of course, because we still have a lot of volatilities going around. We have the climate risk, which, I mean, just now I flew in from Belgium yesterday, and Belgium was going through a heat wave for the first time ever in September, a heat wave. So you feel already, I mean, we had Greece, popular holiday destination, they had the bushfires, and a couple of weeks ago they had all the floods. So it's so much in our face, these climate scenarios, much faster than we all anticipated. Yes, we've been talking about climate for some time, but this seems to be like going out of hands much sooner than we anticipated. So that's where I feel, you can never do enough stress testing, and then sector specific, country specific. Yes, we are from an overall stress testing perspective in a fairly good place, I'd say, but we should never back down. On the contrary, on running much more stresses and even more conservative stresses, concerned stresses, I'd say.
Yeah, better be safe than sorry. And indeed, change seems to be the only constant factor for the moment.
Absolutely.
So thank you, Matthias, for joining today's session.
Thanks for having me, Chris.
Pleasure. We learned a lot about the results that came out of the stress test in Europe. Thank you, viewers, to watch this episode of the ElysianNxt Podcast. If you want to know more about the best risk management system on the planet, please visit us on www.ElysianNxt.com. Thank you for watching.